Okay, welcome to the Real Man of Real Estate. I'll be your host today. My name is Rafael Davis of D&D Capital Solutions. I'm actually here in the studio with my partner, who's also a co-founder and co-CEO of D&D Capital Solutions, but he also has Your Darling Lender. So, and that's my man, my best friend that I've known for many, many years. That's Stephen Darling.
How we doing, guys?
All right, how you doing today, Steve?
Doing good. Happy to be here. Appreciate the opportunity to be here, and looking forward to just talking about what we do each and every day.
Oh yeah, absolutely. So you guys, what we're going to do today is just going to be, we're going to cover real estate. We're going to talk about some different things in real estate, and that's what we're going to do. So that's what we're doing here with the Real Man of Real Estate. So we want to connect with you, the listener, and basically kind of tell you our take on the market with the years of experience that we've had. I personally, I've been a real estate agent since probably about the year 2003. So I've seen markets, come and go up and down in the different markets like that. My man Steve here, my partner, he's been a real estate agent who's now a broker and owner, and he was unique. He worked both sides of the coin here in real estate. So being here in California back in the day, for those who are listening who may remember, but once upon a time, you didn't have to have the NMLS license. So when you were initially licensed in real estate, you can do the loan as well. So once you got your real estate license, you took care of the loan and you took care of the real estate part. So Steve and I, we are from that era. So I know that the new crew, you guys don't get a chance to see that because we don't have that anymore, right? Because there's all these licensing and different things that you have to do now. In fact, Steve and I was just talking the other day about how long the real estate contract itself has gotten. When we first started out, it was just a few little pages, like 3 pages. You remember that, Steve?
Yep.
About 3 pages on the real estate transaction. And now, how many is it?
Oh, geez. The typical contract that goes out is about 20 pages.
About 20 pages, right? And that's up from 3. When we started in this business, it was only 3. Okay, so getting into the show today, we want to kind of address what everyone's talking about, right? So everyone out there, the first thing you hear is rates. What are the rates? Where are they going? They're climbing. We've seen since 2021 how rates have shot up, like almost it seems overnight, even though it wasn't overnight, but they shot up and they shot up fairly quickly. What's your take on that, Steve, for the listeners?
And you're 100% correct on that. It's, everywhere I go, Rafael and I are both family men. We go to sporting events, we go to family events, and everyone's always, they know the business we're in, and they always ask us, what's happening, where are things going, where's the market headed, are we going to a recession, what's up with inflation, where are the rates, what's going on with the rates, all that kind of stuff. And so, why have mortgage rates jumped over 5% in the last month? By the end of last week, there was a shred of hope that the worst might be over for 2022. It's a massive rate spike. But by Tuesday of this week, however, that hope was shredded. Things only got worse from there. To understand why, we have to revisit the general motivation for the rate spike.
Right.
Before we do, let's put massive in context. It's not an overstatement considering that this is the biggest, fastest jump in mortgage rates since 1994.
Wow.
That is insane. And for that, why, it's actually fairly straightforward. The Federal Reserve, which everybody calls the Fed, is the best known for setting the Fed fund rate, which dictates the cost of the shortest term financing. It raises and lowers the rate to try to persuade inflation and employment to remain in certain ranges. And one of the reasons I'm explaining all this is because to the every average person, say you're a mechanic, a doctor, a nurse in the military, you understand and you do a job. On our side of the business, everybody always wonders, because the housing markets is always a conversation, it's always a topic. So I wanted to kind of share these things so that people kind of got an understanding, just a slight understanding of what it is that creates the rates and why they're there and how it drives the market due to inflation, etc. And so the Fed is the one that kind of decides on this based on the bond market short-term financing.
Right.
As mentioned, it raises and lowers that rate to try to persuade inflation and employment to remain in certain ranges. In cases where the rate is cut to zero and the Fed thinks more needs to be done, they buy bonds. U.S. Treasury and mortgage-backed securities is what people in the mortgage business constantly talk about. Buying bonds creates excess demand in the bond market, which in turn pushes long-term rates lower. It's basically a way for the Fed to influence both short and long-term rates.
Are they still, I'm sorry, I didn't mean to cut you off.
Go ahead, no, go ahead.
Are they still in the buying right now? Is the Fed still buying a lot?
Nowhere near the amount they were. Like about a quarter of what they were.
Gotcha.
So at the start of the pandemic, financial markets were in chaos and the Fed stepped in and cut the Fed rate to zero and buying bonds at a very fast rate. Rather than dial back those bond purchases when markets began to settle, the Fed concluded that it should continue providing as much money stimulus as possible in light of COVID's impact on the labor market. They justified this with the assumption that COVID-driven inflation would subside. As the pandemic subsided, as we now know, COVID-related inflation did not subside.
Right.
By the Fed's own admission, it drastically miscalculated the persistence of inflation and even the health of the labor market. As 2022 approached, we suddenly found ourselves staring down the barrel of the biggest inflation numbers in the tightest labor market in decades. Meanwhile, the Fed still has its Fed rate at zero and people are buying like crazy. Rates are super low, refinancing like crazy. They were buying $100 billion a month in bonds in 2021. That quickly changed. The Fed began to wind down the new bond purchases and are all the way down to about a third of that right now.
From what was the number?
$100 billion a month. Yeah, now they're looking at 25 to 30, and I think it's going to go even lower. A few months later, that inflation continued to surge, and the labor market grew tighter. The Fed began accelerating its exit from easy money policies, but much like a battleship in a river, by early 22, the Fed's communication spoke to a certain level of panic not seen since the 80s. The Fed does not like to make big course corrections once it starts to take that proverbial turn.
Gotcha.
But in 2022 has seen those sorts of unexpected accelerations one after another. This rapid rethink and rapid removal of bond buying from 100 down to 25 demand on part of the Fed is the key ingredient in the spike for rates this year. So that's long-winded, a lot to it, but people need to understand why and where and how the rates are going up. Right. So many things are so different about this economy and the monetary cycle that the past precedents may not be as useful as they normally would be. You know, we look to the past to try to gain knowledge or wisdom, but what has occurred now is new, it's different, it's shifting.
Right.
And it could take us months to get back to what they hope would be the normal rate, but the Fed is now hiked up to 5.1, which when rates were at the low twos, the Fed was at about 2.75. Well, now it's at 5.1.
Right.
In my opinion, we are looking at 6 this year, maybe 6, 7 within the next 2 to 3 years, 6, 7, 8 maybe. Mortgage apps are down, building permits are down, home sales are up because of the law of supply and demand.
Right.
Supply and demand is still strictly, it is governing what is happening in our mortgage world or mortgage market. Conventional, people are selling high, buying high, it's apples to apples, but something's going to turn, something's going to change.
Right.
And people don't like to hear that word recession, but, you know, not like, was it 2006? I lived it, I seen it, I dealt with it. We're going to be coming up to something strange, something weird, but a recession will happen, not anytime soon, maybe 2 to 3 years, maybe 5, I don't know, but it will happen, and something's going to change, something's going to happen. I'm not going to try to predict, but I know something will happen. What we do know for a fact is rates will continue to climb.
Right. I think it's important for our listeners to understand that, because oftentimes, you know, you talk to people and everyone's talking about, hey, you know what, I'm going to wait, I'm going to see, I'm going to wait. You know, in the big realm of everything, you know, the longer you wait, it seems like that's kind of like the more you're going to end up paying, right? Because I heard people say, well, when rates were down to, two and a quarter, 2.5, 2.25. I remember I used to talk to people because, I've been blessed to be on both sides of the fence. So I do the private money, but I can also do the conventional, as you know, us being partners. And I would talk to people, even family members, and be like, hey, listen, now is the time. We're seeing historical low rates. Rates haven't been this low since like 1979, I believe. Don't quote me on that, listeners. I may have the wrong year, but 1979. And then there was a little stint in like 2012. In 2012, I remember rates went down to like 3.25, and some people were very lucky during that week because they were able to lock in their rate, and it was low. It was low, and
it
of course,
didn't last like it did.
It didn't last
like
at all.
time.
It kind of just rebounded and went right back up,
Yep.
and people waited, and so now people are still waiting. I had a guy call me the other day, and hey, Rafael, man, I've been seeing these rates going up, and I don't think they're gonna, stop anytime soon. I should go ahead and, try to refi and pull some cash out of my house, and I had to tell him, I'm like, well, hey, man, let me tell you, it's much different from when I spoke to you 8 months ago. Things have changed, it's not, I think back in 8 months ago, I was telling him it was like 2.5. And now I think when I pulled it up and looked at it, it was like, may have been like right at 4.2. I think with no cost. No, was it 4.2? I can't quite remember. But I tell you what, I'll think about that here in just a second. So let me get ready, and we will go to a quick commercial break. We'll come back. Again, this is Rafael Davis with D&D Capital Solutions, sitting here with my partner, Stephen Darling of Your Darling Lender, and Darling Homes and Estates, which we haven't touched on yet, and also the other half of D&D Capital Solutions. We'll be right back after this break.